Last section on risk and return. Here are our topics for this final segment: portfolio manager performance, market equilibrium, market efficiency, and CAPM and market efficiency. We have two portfolio managers, JJ and CC, and we want to judge their performance. Comparing their actual performance with the required return from CAPM on each portfolio, JJ comes out as the better performer. Placing both portfolios on the security market line, JJ plots above the line. JJ's performance was better than required by the market. CC plots below the line, subpar performance. This flowchart goes down two legs, the insider leg on the left, yellow, and the right leg, blue, as perceived by outsiders. The assumption is that insiders in a firm know the true value of a firm's stock, its intrinsic value. Outsiders try to perceive the true value through signals from the firm's management, and based on their perceptions, they arrive at a market price. If the market price and the intrinsic value are equal, the market for the asset is in equilibrium. Equilibrium means the required return equals the expected return. There's no pressure to buy or sell an asset. It's fairly priced. Basically, if you think the stock is going to outperform its current market price, then it's a bargain. You and others will buy it, driving the price up and the return down, so it'll plot on the SML line. Price pressure in the market drives prices up or down to force assets to plot on the security market line. Financial markets in the U.S. are highly informationally efficient. That means relevant information concerning the value of an asset is reflected very quickly in the stock price. If you and I hear about it, it's already history. This is the basis of the efficient market hypothesis developed by Batchelor in 1900 and expanded and further defined by Eugene Fama in 1960 and 1972. The key point for us is that if markets are truly efficient, then stocks are normally in equilibrium. It is not possible to consistently beat the market. Stock prices do get out of sync, but are quickly found by analysts, and price pressure is exerted to bring prices back in line. Market efficiency is maintained due to competition and the basic profit motive. For most of us, finding a small mispricing would not yield a profit after transaction cost. For professional traders managing huge sums, a small per-share profit can translate into millions of dollars. Eugene Fama defined market efficiency as having three forms: weak, semi-strong, and strong forms. Now, efficiency relates to informational efficiency, and the general consensus is that our markets are semi-strong form efficient. The three forms are nested in the sense that if a market is semi-strong form efficient, then it is by default also weak form efficient. To test the efficient market hypothesis, choose a trading strategy that takes advantage of the market if it is not efficient. Choose an asset pricing model, like CAPM, to measure required return versus actual return. If the test rejects the EMH, then either the efficient market hypothesis is wrong or the asset pricing model is incorrect. This is a joint test. The next three slides define the forms more completely. Weak form efficiency states that current prices already reflect all the information contained in past prices and volume. Technical analysis is quite common in futures markets, and you've probably heard analysts talk about resistance and support. These are technical analysis terms. Weak form market efficiency is generally supported empirically. Basically, very few trading strategies based on prior price or volume movements result in abnormal returns. There are two exceptions: short-term momentum, long-term reversals. Semi-strong form efficiency states that prices reflect all publicly available information. The information considered in semi-strong form efficiency is fundamental analysis, studying earnings reports, for example. Again, most empirical evidence supports strong form efficiency, again with two exceptions: small companies and companies with high book-to-market ratios. The key point here is that if markets are semi-strong form efficient, then what's the role for active portfolio management? Strong form efficiency states that stock prices reflect all information, public and private. Clearly, trading on inside information is profitable, but illegal. We've seen market bubbles in recent years, the so-called dot-com bubble from roughly 1997 to 2000, for example. In a bubble, prices rise quickly for no rational reason. Trading volume rises as well until the bubble bursts and prices decline quickly. Behavioral finance studies how people behave, specifically in terms of investing. It's an entire area of finance, and one we don't have time to go into in this class. Some of the studies of human behavior relative to investing helps explain why investors can't recognize a bubble and they continue to invest. As the slide says, the bottom line. Several years ago, the head of a major fund company, in an industry speech, basically advised investing in index funds. If markets are indeed efficient, then you cannot beat the market through traditional investing strategies. His remarks were not very popular in the industry. CAPM is taught in virtually every finance class, yet it has not been empirically proven. CAPM is in widespread use and revered for its simple, elegant approach to relating required return to risk in the market. There are a variety of more complex multi-factor models in use by serious analysts, for example, the Fama-French three-factor model and arbitrage pricing theory. There are statistical reasons that make testing difficult. CAPM is an expectational or ex-ante model, yet the only data available to test it is historical or ex post, and beta is based on historical data. This ends Chapter 6. From here we'll go to Chapter 25, Portfolio Theory, which follows nicely from CAPM in this chapter.